What's up, good people? My name is Daniel Walcott, and welcome back to my channel where we talk about all things real estate investing, wealth building, and home ownership. And so in today's video, I want to talk about the 10 things that you need to know about FHA loans. FHA loans are really popular, so I want to make sure you guys have all the information that you need before you go down the path to get pre-approved and talk to a lender and eventually use and close on a home. And so without further ado, let's get into it.
They tryna at me, I'm running the race. I gotta pick up the pace. They throwing shade, but I'm gone. You gotta keep it a buck to my face.
An FHA loan is a government-backed mortgage insured by the Federal Housing Administration, also known as FHA. FHA loans are popular with first-time home buyers because their flexible underwriting standards allow buyers with less than good credit to still become homeowners. Now, although the government insures a loan, you'd actually get the loan through traditional mortgage lenders, and they come at a fixed rate in 15 or 30-year terms. All right, so number one is qualifications. In order to use an FHA loan, borrowers must have a credit score of 500 or higher. However, in order to use the 3.5% down payment, which is offered through the program, you must have a credit score of 580 or higher. So if you were to have a credit score between 500 and 579, they'll actually require you to put a minimum down payment of 10%. Now here's a pro tip. Don't put down 10% for an FHA loan. If you're in a position where your credit score is lower than 580, or maybe you're a few points away, or if you're on the lower end, spend the time and money to fix your credit to get it as high as possible so then you can qualify, because financially it's not a good decision to put that much money down on an FHA loan, especially if you could just get your credit score up a little bit and qualify for 3.5% down. What you'll also find is that some lenders may still require you to have a minimum of 620 credit score in order to qualify for FHA. And so what's happening is that FHA has their guidelines on who can qualify for FHA, but the lenders who are actually giving you the money has their own set of guidelines. And so while FHA may say, hey, at 580 you can get the loan, a lender may not feel comfortable with doing the loan if you're less than 600 or 620. And so I say that because you may find yourself shopping around lenders and you'll say, well, hey, my credit score is 585. How come I can't get the loan? It's not because FHA you don't qualify, it's the set of guidelines that the lender has. Now, FHA actually has maximum lending limits that they have set throughout the country. And so depending if you live in a low cost area or a high cost area would depend on what that limit is. If you're in a low cost area for a single family, that loan limit is a little over 420. If you're in a high cost area, that loan limit is 970,000. In my opinion, I haven't really seen that be an issue. I find that the loan limits are generous enough where that typically doesn't come into play for people who are looking to purchase a home. Now, in addition to having a qualified credit score, FHA also requires that you have a verifiable employment history for the past 2 years. Now, lenders are able to verify employment and income through pay stubs, bank statements, and federal tax returns. That means you can't have a job that's off the books, or you can't be paid under the table, or you can't have a large gap of unemployment within the past 2 years. They're going to be looking at those documents to confirm that information. In addition, the loan must be used as your primary residence. That means you can't use it for a rental property or investment property. If you are using it to purchase a multifamily, you can obviously rent out those other units, but you would have to occupy that unit as well. So this is what we call an owner-occupied loan. In addition, the property must be appraised by an FHA appraiser. You don't have to worry about that. The lender is going to make sure that that part is done, but the property must meet HUD guidelines. And so we'll talk about that a little later in the video. The last financial qualification when it comes to FHA are going to be your front end and back end ratios. Now, your front end ratio is what your mortgage payment is or would be divided by your gross monthly income. That number shouldn't be higher than 31%. Depending on the circumstances, some lenders may allow you to go up to 40%. Now, your back end ratio is your monthly mortgage payment plus your other monthly debt obligations, such as your credit cards, your student loans, car note, personal loans, whatever kind of debt that you're paying monthly on. They're going to take that plus your mortgage payment and divide that by your gross monthly income. And that number shouldn't be more than 43%. However, it's up to the lender's discretion. In some scenarios, they're actually able to go up to 50%. All right, so let's move on to number 2. The second thing that I want you to know about FHA loans is that it's not a first-time homebuyer program. Now, there are many benefits that come along with being a first-time homebuyer, but qualifying for an FHA loan is not one of them. As I mentioned earlier, FHA is very popular with first-time homebuyers. I believe they did a study last year that said 83% of FHA loans went to first-time homebuyers. But as long as you meet the other qualifications, you can use FHA for your second, third, or fourth home. And that brings me to number 3. You can only have one FHA loan in your name at a time. Now, that doesn't mean you can only use it once. You can use FHA multiple times, but you would either have to sell your property before you close on the new one, or you would have to refinance into a conventional loan or some other type of loan. Now, FHA guidelines allow for borrowers to use co-signers in order to qualify for the loan. They can be both occupied or unoccupied co-borrowers. However, if you co-sign on someone else's loan, that's your loan now. You may not be making the mortgage payments, but any payments made or any late payments are now gonna appear on your credit report. Not only that, but because you have a whole mortgage on your credit, it may be difficult for you to apply and get approved for another mortgage if you were looking to purchase another home or purchase something for yourself. Another pro tip, if someone were to ask you to co-sign on their mortgage, you better think long and hard about it, because there's little to no benefit for the co-signer, which is why FHA guidelines actually require that the co-signer be a relative. You would actually need to refinance if you wanted to remove yourself from the loan in order to either qualify or use FHA for yourself. One last thing about co-borrowers before we move on to number 4. If you're thinking about using a co-signer, it should not be because you have low credit. When FHA lenders review mortgage applications with 2 borrowers, they actually look at the lower person's score, and they're gonna use their scores in order to qualify. You should apply for an FHA loan with a cosigner if you have a high debt to income ratio and you wanted to use your cosigner's income in order to qualify or qualify for more. Every cosigner will still need to meet the minimum standards and guidelines. All right, number 4, minimum property standards. Now, sometimes buyers are confused or taken aback that they're actually not able to purchase a certain home because it doesn't meet the minimum standards for FHA. FHA loans must meet safety, security, and soundness standards. And that's going to include things like the roof, property access, electrical, plumbing, water heaters, among some other things. FHA is typically not going to require any like cosmetic repairs or minor defects as long as it doesn't interfere with the safety, soundness, and security of the property. Now, this is usually gonna come up during the appraisal. The purpose of the appraisal is twofold. 1, it's to determine the value of the property, but 2, it's also to determine if the property meets the minimum standards for the FHA program. Now, here I'm gonna list a couple things that are usually flagged during an FHA appraisal. In addition to this, FHA requires that the kitchen appliances be in working order as well. Now, as a buyer, if you were to come across a situation in which one of these items were noted in the appraisal, you wouldn't be able to move forward with your purchase and close until the seller made those repairs and the appraiser went back out to the property to confirm that those repairs were made. Here's another pro tip. Hire a knowledgeable and capable home inspector. The home inspector is typically going to inspect the property a week or 2 before the appraiser does. And so during the home inspection, you want to ask if certain things are going to be flagged during an FHA appraisal. And if they are, you can reach out to the seller beforehand and let them know, hey, these things need to be fixed before the appraiser goes back out to the property. Doing that small thing can prevent you from delaying settlement or causing any issues with the contract later on in the process. All right, number 5, mortgage insurance premium. When using an FHA loan, they're gonna collect a one-time upfront mortgage insurance premium, and you'll also have to pay an annual mortgage insurance, which is broken up into monthly payments. Now, your upfront mortgage insurance premium is going to be 1.75% of the loan amount, and the annual premium is gonna vary depending on the loan amount and some of the other terms, but for most borrowers, it typically comes out to about 0.85% of the loan amount. Unlike regular home insurance, the mortgage insurance premium, or MIP, is there to protect the lender in case you as a borrower were to default on the loan. Now, mortgage insurance is typically required anytime someone puts less than 20% down on a property. However, for FHA, it's always required. And because of that, you typically have higher closing costs when using an FHA loan. That 1.75%, that upfront premium, that's a fee that's not included with other loans such as VA or conventional. Now that amount is added to your closing costs, but it can also be wrapped up and financed into the loan. Now the annual mortgage insurance premium can range anywhere between 0.45 to 1% of the loan amount. And again, although it's listed as an annual fee, it's actually split up monthly and you pay it part of your monthly mortgage payment. Now, this stays with you for the life of the loan. The only way to get rid of mortgage insurance with FHA is to either sell the property or to refinance into a non-FHA loan. Another pro tip, the mortgage insurance premiums that you have to pay is not avoidable when using an FHA loan. So just chalk it up as the cost of doing business. However, if you're able to qualify for a low down payment conventional loan, you should strongly consider it because your closing costs are going to be significantly cheaper. All right, number 6 is condos. Now, when it comes to condos, FHA has its own set of guidelines that the association and building has to meet in order for that property to be approved for the loan. Now, the first number you need to know is the investor ratio. FHA guidelines state that no more than 50% of the units within an association can be investor owned. So that means somebody may have purchased a condo within that association, they may have lived in it for a couple years, and then they rented it out. Anyone who owns a condo unit but doesn't live in it as their primary residence, in the bank's eyes, is considered an investor. And so no more than 50% of investors can occupy or own units within that association and still qualify. Next is delinquency. If 15% of homeowners within the association are 60 days or more behind on their condo fees, the lender can deny you financing and not allow you to use the FHA loan. I usually don't see this come up, but there is a guideline that states that no more than 50% of the loans within an association can be FHA. It's rare, but it may happen. Now here's a pro tip. If you actually go on HUD's website, there's an area where you can actually look up to see if your condo is FHA approved. Number 7 is student loans. Now, regardless of your payment status, the lender has to use your student loans to calculate against your debt to income ratio. And there's 3 ways that they can do that. The first is that they can use your actual payment, whatever you're paying monthly on your student loans. They can use what's reported on your credit and calculate that against your debt to income ratio. Or if you're not making payments, or if your loans are in deferment, or if there's nothing on your credit report, then they'll take 0.5% of the total loan amount and calculate that against your debt to income ratio. All right, number 8 is renovation loans. When it comes to FHA, they're known for 2 things: having a low down payment of 3.5% and 203K, which is their renovation loan option. Now through 203K, you're able to purchase a home, renovate it under one single mortgage. Homeowners can also use FHA 203K to refinance their current mortgage and include the cost of a remodeling project into that as well. So it's actually a really cool product. So FHA 203K actually has 2 options. We have limited 203K, which gives you up to $35,000 to make repairs and improvements. This program will typically be a little less involved and less paperwork. So if you want to do maybe a smaller project, like a kitchen renovation or a bathroom renovation, you can use the limited 203K, and it's perfect for something like that. Now, standard 203K is a little more involved, and you actually may have to hire what's known as a 203K consultant to help manage the project. While you can use standard 203K for smaller projects, I think the minimum is $5,000. Typically people use it for when they want to borrow more money that they aren't going to be able to do with a limited 203K. Now the beauty of 203K, it allows you to purchase a home and finance the repairs, which include material and labor. So ideally, you wouldn't actually have to come out of pocket outside of what the mortgage is for the project. Number 9 is closing costs. So FHA allows home builders and sellers to pay up to 6% of the buyer's closing costs. Now 6% is typically a lot more than what sellers are willing to contribute to a buyer's closing costs. We find on average that number is probably somewhere between 2 and 3%. However, we're going into a more favorable market for buyers. And so if there's an opportunity for your agent to negotiate a higher closing amount, Just know that you can go up to 6% if you're using an FHA loan, and that's something that you can't do with some of the other loan programs such as conventional or VA. And that brings us to number 10, which is fix and flips. FHA will not allow the financing of a home that's considered a flip less than 90 days from the deed recordation date. What does that mean? Mortgage lenders define a property flip as a home that has been owned for a short period and then sold for a sizable profit. So when you're dealing with the flip, the clock starts at the deed recording date. So if I'm an FHA buyer, I cannot purchase that property or go under contract until day 91. So if you were to have somebody who were to go in and fix up the property within 60 days, they cannot sell that property to an FHA buyer until day 90 has passed. Now, if the resale date is between 91 and 180, that means if within that time period, I go under contract with an FHA loan, and if the purchase price is 100% more than what the seller had paid for it, the lender and FHA is gonna require a second appraisal be done on the property. For an example, if the seller paid $100,000 for a property, fixed it up, and now wants to list it for $200,000, then the lender is going to require that a second appraisal be done to the property. Now, here are the rules for the second appraisal. Number one, the second appraisal has to be done by a different appraiser. Number two, the buyer is not responsible for paying for the second appraisal. 3, the appraisal must include documentation to support the increase in value. 4, the lower value must be used if the second appraisal comes in 5% lower than the first. Can get a little confusing, but that's how it is. The FHA wants to protect not only itself, but the buyer from somebody who may be trying to defraud the system. But that's all I have for today. I appreciate you guys for sticking around and learning all about FHA loans. If you guys have any questions, or if you're looking to purchase a property in the DMV, please reach out to me and my team, MG Residential. We'd love to support you in your real estate goals. And last but not least, I need 2 huge favors. Please like and subscribe. Liking lets me know that the information I'm giving is relevant to you. Subscribing lets me know that you want more. I'll see you guys next time.